Hi, AAII here from Shinder Tremblay Private Wealth with AAII Private Wealth. Recently, some people have been pointing to the overly bearish positioning by retail investors highlighted in a recent American Association of Individual Investors survey, which is a sentiment survey done in the US as a catalyst for a potential market bounce. Should we even consider this survey before making an investment decision?
No one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Basically, surveyors are asking retail investors if they are positive, neutral, or negative on equities for the next 6 months in order to gauge sentiment. From that, market pundits are then looking at comparable past readings and how stock markets reacted to similar readings. Currently, they are comparing the current high negative sentiment to March 2009 as a bullish sign for equities because in 2009, the market ripped higher. Because markets do not like imbalances, and one way to be a successful investor is to invest differently from the herd, as eventually, sentiment will change, and as an investor, you will profit from this. Let's look at this relationship between bearish readings and ensuring market bounces holds. By looking at this chart from late 2007 to late 2009, there is absolutely truth to this, but it is far from being perfect. The blue line is the percentage of negative reading, the yellow line is the S&P 500 level, the green check marks are showing the periods where it actually worked, and the red X's when it was just a false signal. I would highlight the fact that from a fundamental standpoint, the current environment is nothing like 2009. Let's anyway compare 2009 to now. In 2009, the market fell close to 50%, we were in a recession, unemployment was over 10%, a wave of bankruptcies that occurred, central banks were easing, and earnings multiples had bottomed. As an investors, the odds were more in your favor as the pain was in the rearview mirror. Now, the backdrop couldn't be more different. Currently, corporate profit margins are at historical high, we have the lowest unemployment in over 50 years, peak debt levels, valuations are still expensive, and central bankers are raising rates. It would be an understatement to say risks are higher now than back then. Some parting words: this survey is useful if you want to trade potential bounces, although those bounces could be vicious in bear markets. That's what they are, bounces, and should be treated accordingly. I addressed this subject in my previous video. Trade carefully. If you want to know more about this or any other topic, or if you want to see if your portfolio is well positioned, give us a ring, follow us on LinkedIn, or send us an email. Thank you.
No one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.